Hi, I'm Justin Kuntz with Pacific Wealth Management. To accompany our most recent market comment, we wanted to share a few charts to give a little context behind what's happening in today's volatile markets. This first chart shows the S&P 500 relative to daily trading sentiment on the bottom in orange. This most recent market volatility has definitely brought sentiment down over the course of this year. You can see on the far right-hand side of the lower chart, we're at very, very low readings, meaning the market is extremely pessimistic about what is going on today across the board. It's not too surprising given the market's negative performance. Usually, this is what we call a contrarian indicator, meaning that when the orange line is in that lower zone of extreme pessimism, the markets tend to return positively. You can see in the chart on the very bottom of this page how average returns when we're in that lower zone are closer to almost 27% annually. While historically, when sentiment is in the extremely pessimistic range, it has translated into positive performance for markets. In more recent years, this indicator hasn't necessarily been as consistent. So we'll have to wait and see how things play out from here. The second chart shows the U.S. household asset allocation as a percentage between stocks, real estate, cash, and bonds. Right now, U.S. households hold a lot of stocks. We're actually if we were to look back in history, we're actually at the higher end, if not the highest, that households have ever held in stocks relative to these other asset classes. It doesn't spell good things when it comes to market volatility, especially given the fact that most of these households will make decisions based upon how well the stock market does. The other dynamic to consider when households hold a large percentage of their wealth in stocks is there aren't a lot of other sources to tap when someone wants to buy stocks. When individuals have low amounts of cash, low amounts of bonds, light amounts of real estate, it translates into a lack of buying power for stocks to keep the market going up. And while the American household holds a lot of stocks, institutions in the United States also are holding a record high percentage, just short of the level that they held in the year 2000. You may recall the year 2000 was right around where the dot-com bubble burst. So it doesn't spell great things for the expectation of volatility moving forward. On the flip side of the coin, it's not all bad news. There certainly are a number of things to point to that could mean our stocks continue to go higher in the United States from here, especially given the strength of the U.S. economy. Let's take a look at a next chart, which shows a little bit more about the optimism for CEOs in the United States, actually moving in the right direction, surprisingly so. You can see in the last couple of years how much CEOs' confidence has moved into the optimism zone just recently. While historically stocks have underperformed while the CEOs have been in that optimistic realm, they still tend to behave positively. Stocks still tend to go up during that time frame. In addition to CEO confidence, market breadth has actually recently improved. While the trend has been down in recent months given the market's slide, the percentage of stocks that currently reside above their 200-day moving average has actually bumped up quite a bit in recent days. That's a good sign for markets. Market breadth is a really good indicator for future strength in stock market prices. So we pay close attention to this, and if this continues to improve, it could mean that the markets have hit a bottom. While stocks could bounce from here, there are a lot of bigger headwinds at play, valuation being probably one of the largest in that conversation. Right now, stocks are relatively overvalued and sit at the higher range of price to earnings ratios. That makes it challenging for stocks to continue to rise if earnings do not surpass expectations. The middle and bottom clip of this chart give you a better idea as to relative valuation of the stock market compared to gross domestic income. When the lines are above the hashed line, it tends to mean that we are overvalued or in a expensive range for the stock market. As you can tell right now, and even for the last decade, the stock market has been in that elevated range. So therefore, it's challenging for stocks to continue to rise when valuations are this high. Earnings will play a key role in what happens from here for the stock market. If they surpass expectations, we very well may see a stock market that performs well. If they disappoint, it could mean lower prices from here. All in all, it's a mixed bag of data these days when it comes to the S&P 500, and underneath it all, the economy continues to remain on solid footing. That's been evidenced by the Federal Reserve Bank's most recent move in not changing interest rates. I think that's a key indicator here that tells us that what Jerome Powell and his team are focusing on is the fact that while there is a lot of noise going on in the economy today and in the news and the media, especially around geopolitics, the economy in the United States remains on relatively good footing, and we'll continue to lean on that as we build asset allocations for clients to participate in the growth of this U.S. economy. If things shift gears and change into another negative direction or a different direction, we'll obviously shift as well. But until that happens, we're paying close attention to the data, and we'll make adjustments as needed along the way. So let us know if you have any questions. Feel free to reach out at any time. Thanks for watching.